what everyone is missing. While everyone is chasing the shares of Nvidia and Tesla, the market is ignoring a quiet revolution in the fields of America. A company with a 188-year history is turning into a technology giant that controls 60% of the market for high horsepower tractors in the United States and Canada. But this is only the beginning of the story. John Deere is now trading at a price of about $475, having fallen by 11% from its yearly high in May 2025. Investors are frightened by a 29% drop in profit and a cautious forecast for 2026. The market sees an old tractor company in a cyclical downturn. The market is wrong. Here is why. The problem agricultural production on the verge of collapse farming is going through a crisis that cannot be solved by old methods. A critical labor shortage. In the United States, 2.4 million agricultural job openings need to be filled each year. 88% of contractors cannot find qualified machinery operators. 86% of landscaping companies experience staff shortages. The average age of a farmer in the United States is 58. Young people are leaving the industry. Rising costs destroy profitability. Fertilizer prices have increased 2 to 3 times in recent years. Herbicides, pesticides, fuel, everything is becoming more expensive. The profitability of farms is falling to critical levels. Global demand for food is growing. Earth's population 8 billion, 10 billion by 2050. It is necessary to produce 70% more food on the same land. Climate change makes yields unpredictable. Traditional farming cannot solve these problems. A revolution is needed. The solution. Deere is turning tractors into robots with a subscription. While the market thinks that Deere sells tractors, the company has quietly become an AI company with hardware. 1. Fully autonomous tractors are already a reality. At CES 2025 in January, Deere presented a new generation of autonomous machinery, Autonomous 9RX Tractor. I-16 cameras provide a 360-degree view. Operates 24/7 without brakes. The farmer can sleep while the tractor plows. Second-generation autonomy, faster, more accurate, can pull more equipment. Price $500,000 for the tractor, plus a subscription for autonomy. Autonomous 5 ml orchard tractor. Designed specifically for orchards and vineyards. LiDAR sensors for navigation in dense tree canopies. Spraying without manual labor. A complex and repetitive task is automated. The key point. Tractors of 2025 are produced autonomy-ready directly from the factory. Any tractor of the 8R or 9R model from 2020 onward can be upgraded to autonomous using a retrofit kit. This is not the future. This is already working in the fields. 2. See and spray, a technology that pays for itself instantly. Imagine your sprayer driving across the field and seeing each plant individually. AI determines whether it is a crop or a weed, and sprays only the weeds. Results of 2024. 59% savings on herbicides on average, 8 million gallons of chemicals saved on 1 million acres, 60% reduction in chemical costs. For the farmer, this means savings of $20 to $40 per acre only on chemicals. On a 1,000-acre farm equals $20,000 to $40,000 in yearly savings. The technology pays for itself in 1 to 2 seasons. Competitors with such accuracy simply do not exist. 3. Transition to subscriptions, a revolution of the business model. Here is what the market is categorically underestimating. Deere plans to receive 10% of revenue from software and subscriptions by 2030. What this means in numbers, current revenue approximately $45 billion per year. 10% from subscriptions equals $4.5 to $5 billion of recurring income. Software margin 85% versus 25% for equipment. Compare. To sell a tractor for $500,000, a 25% margin equals $125,000 of profit one time. A subscription of $10,000 per year for AI functions, an 85% margin equals $8,500 per year continuously. Subscriptions make the business predictable, profitable, and resistant to cycles. Examples of subscriptions: autonomy, annual fee for the use of AI systems, see and spray TM, fee per acre of treated land, John Deere Operations Center, cloud platform for data analysis, precision ag subscriptions, recommendations on seeding, fertilizers, yield. By 2030, 1.5 million units of machinery will be connected to the cloud. This is a gigantic base of recurring revenue. Evidence, numbers, and facts. December 2025. Financial indicators. Current situation, as of December 2025. Share price, $475. Close of December 5, 2025. Capitalization, Approximately $120 billion P/E, approximately 25, higher than the historical median, approximately 18, but considering the transformation. Dividend, 1.4%, $1.62 quarterly equals $6.48 per year. 52-week range, 403, 534. Financials of 2025, full year. Revenue, $45.68 billion, decline minus 11% due to the cyclical downturn in agriculture. Net profit, $5.03 billion, decline minus 29%, cyclical bottom. Q for 2025, revenue exceeded forecasts, but the outlook for 2026 is cautious. Forecast for 2026, expected continuation of difficult conditions in the market for large agricultural machinery. Revenue, approximately $41.2 billion, another minus 10%. EPS, approximately 21.05, growth from the current $18.50. Forecast for 2027, revenue $44.7 billion, EPS $26.91. Why this is not scary? This is the cyclical bottom. Farmers are postponing the purchase of new tractors due to high Federal Reserve rates and a difficult economic situation. But machinery wears out. Replacement is inevitable. Historical pattern. After every cyclical downturn, Deere returned stronger. Competitive advantages. Technological dominance. Deere invested billions in R&D over the last 10 years, $2.267 billion on R&D in 2025, plus 1.5% year over year even in crisis. Competitors, CNH, Industrial, AGCO, Kubota, lag 3 to 5 years behind in autonomy. Ecosystem lock-in. John Deere. Operations Center, cloud platform for farmers. All data from machinery flows into a single system. Switching to a competitor equals losing the entire history of data. Effect like Apple, bought one Deere tractor, you will buy the whole fleet dealer network, 1,500 plus dealer centers worldwide. Service and support 24/7. Dealers are transforming into agronomic consultants. Data equals the new oil. Each tractor collects data. Soil, yield, weather, pests. 10 trillion corn and soybean plants are planted in the United States annually. Deere collects data from this entire volume. Competitors need decades to gather such a base. Barriers for competitors. Why no one will catch up with Deere? Cost of entry? Astronomical. Development of an autonomous tractor. $10 billion plus in 5-10 years. Experts in AI, computer vision, robotics, agronomy are needed. Deere acquired startups. Blue River Technology, $305 million 2017. Bear Flag Robotics, $250 million 2021. Software ecosystem. Rewriting software for a new platform equals years of work for a farmer. Deere already has millions of acres of data in the system. Network effect. The more farmers, the smarter the system. Brand trust. 188 years on the market. Farmers pass equipment from generation to generation. Buying a tractor equals an investment for 15-20 years. No one will risk a new brand for such a period. Regulatory barriers. Autonomous machines require safety certification. Deere has already completed all procedures. New players need years for certification. Risks. Honesty equals trust. Short-term risks. Cyclical downturn in agriculture. 2025-2026 will be difficult years for farmers. Low grain prices, high Fed rates. Sales of large equipment will fall by another 10-15%. Why this is manageable? Deere has gone through 10-plus cycles in its history. The company has built up reserves and optimizes expenses. Small equipment and the construction segment compensate part of the losses. Trump tariffs. Tariffs on steel and aluminum increased production costs. Deere estimates the hit at $255 million in additional expenses in 2026. The trade war with China affects demand in Asia. Why this is manageable? Deere can partially pass costs into prices. Negotiations with suppliers and optimization of supply chains. Farmer resistance to subscriptions. Some farmers are against the software lock. The right to repair movement demands access to the software. 77% of farmers buy older equipment to avoid subscriptions. Why this is manageable? The younger generation of farmers grew up with technology. ROI from AI systems is obvious, saving $20-40 per acre. See Apple's history. At first, everyone was against a closed ecosystem. Then everyone bought an iPhone. Long-term risks. Emergence of competitors. Startups such as Agtonomy, Monarch Tractor. CNH Industrial and AGCO also invest in AI. Why this is unlikely? Startups focus on niches, vineyards, orchards, rather than large grain farms. Traditional competitors lag 3-5 years behind. Deere's ecosystem has already created a network effect, technological shift. A new technology may replace tractors, drones, swarm robots. Why this is unlikely? Tractors equal a proven 100-plus year technology. Large areas require large machinery. Deere actively buys startups and adapts new ideas. Financial logic. Why this is profitable. Current valuation versus potential. Today, December 2025. Price, $475. PE, approximately 25 at the cyclical bottom of profits. Average analyst estimates, 12-month target, $526, plus 10-11%. Rating, buy, 18 analysts. But this is conservative. Here is the real potential. Scenario 1, cycle recovery, 3-5 years. Base case, the agricultural cycle recovers by 2027-2028. Revenue returns to $52 billion. EPS, 27.30 versus current $18.50. PE returns to the median 1820 multiplied by. Share price, $500-$4,600 plus 15-25%. Scenario 2, subscriptions take off, 5-10 years. Bull case, by 2030, subscriptions equal 10% of revenue equals $5 billion. Margin 85% equals $4.25 billion of operating profit from software. This adds $14-$17 to EPS at software company multiples. PE on software revenues equals 30-40 multiplied by versus 15-18 multiplied by on equipment. Total EPS 35-40. Share price $700-$900 plus 45-90%. Scenario 3, Deere becomes the Apple of agriculture, 10 plus years. Extreme case. 1.5 million machines are connected to the cloud. Average subscription, $5,000, $10,000 per year per machine. Recurring revenue, $7.15 billion per year. Margin, 85%. Market cap repriced like a tech company. Share price, $1,000 plus 100% plus. Comparison with alternatives. Investment, growth potential, 5 years. Risks. S&P 500 index, 8-10% annually. Medium. Nvidia, 15-20%, already expensive. High, AI bubble. Caterpillar, 10-12%, medium, cyclical. Deere, 20-30% annually, medium, cyclical plus transformation. Deere gives protection from inflation, real assets, exposure to the AI revolution, dividends, 1.4%, cyclical recovery plus structural growth of subscriptions. What to do? Concrete recommendation. For a long-term investor, 5-10 years, buy now. The price is at the cyclical bottom. Buy more on any drop below $450. Hold for at least 5 years. The transformation takes time. Optimal strategy, enter gradually. 30% of the position now, December 2025. 30% if it drops to $450, $460. Possible in Q1, Q2 2026. 40% if it drops below $430. Unlikely, but possible. Investment horizon, minimum 5 years. By 2030, subscriptions will show results. Optimal 7-10 years, full realization of potential. What to track? Quarterly reports, growth of recurring revenue. Adoption rate of subscriptions for See and Spray and autonomy. Investor Day, held on December 8, 2025. Strategy for 2026-2030. Who this is not suitable for. If you need money in the next 1-2 years, the cycle may drag on. If you cannot tolerate 20-30% volatility. If you believe the AI bubble will burst and drag everything down. Final verdict. Deere & Company is not an old tractor company. It is the leader of the AI revolution in agriculture. A shift from selling hardware to subscriptions with an 85% margin, an insurmountable technological lead over competitors, a cyclical bottom that creates an entry point with a 20-30% discount. The market punished the stock for a short-term downturn. Smart investors buy when everyone is afraid. Risks exist, cyclical downturns, tariffs, farmer resistance, but fundamentally, the business is transforming into a high-margin tech company with recurring revenue. Target price by 2030, $700 and $900. Plus 50-90% from current. If you are ready to endure 2-3 years of cyclical bottom for 5-10 years of structural growth, this is one of the best investments in an undervalued transformation. Data is current as of December 2025. This is not financial advice. Always conduct your own analysis.